Now let's talk about the yield curve. The term structure of interest rates is simply the relationship between interest rates and maturities, while the yield curve is the graphic depiction of that relationship. So let's look then at some sample interest rates and their maturities. Now, if it's going to be a true term structure or a yield or graphed as a yield curve, then all of these rates have to be offered by the same issuer. So that's another key point here. So now we're looking at treasuries, and because that's the one that we usually look at when we're talking about a yield curve. Here are some treasury interest rates from 2006, 2007, and 2013. So we have maturities ranging from 1 month to 20 years. So we have very short term to very long term interest rates. And so we can see with some of these, or one in particular, 2013, we see as the term to maturity gets longer, the interest rate gets higher, but not necessarily so in 2006 and 2007. So now if we graph these, here's what we see. For the 2013 yield curve, we see an upward sloping yield curve, which we consider normal. And then for 2006 and 2007, we see a pretty flat yield curve. So a flat yield curve generally indicates that there's some uncertainty in the market about what's going to happen in the future, especially surrounding inflation. So let's try to explain in more detail reasons for the shape of the yield curve. Again, keep in mind, as I mentioned, that the yield curve is typically upward sloping, which is what we call normal. So 3 popular explanations then for that shape are the liquidity preference theory, the expectations theory, and the market segmentation theory. So liquidity preference theory says that investors prefer short-term securities because they're very liquid, they're not locked in for a long period of time, and so that means that those short-term rates should be low and long-term rates should be higher in order to kind of get them to consider longer-term securities. The expectations theory is based on investors' expectations about future inflation. So if investors think that inflation is going to go up in the future, then you're going to have an upward sloping yield curve. If they think inflation is going to go down, then you'll have a downward sloping yield curve. And so here's how we calculate interest related to that expectation theory. We're going to take an average expected inflation rate. So just what we expect the inflation rate to be over time divided by the number of years in that time period. So here we've got a year 1 inflation of 5%, year 2 is 6%, and year 3 is 8%. And we have a real risk-free rate and a maturity risk premium. So the inflation premium for year 1 is just going to be that 5%. But the 10-year inflation premium is going to be the average of the inflation for the next 10 years, so 5 plus 6 plus 8 times, divided by 10. And then for the 20-year premium, 5 plus 6 plus 8 times 18 times, divided by 20. So that gives us our inflation premium for 1 year, 10 years, and 20 years. And so now, because we were given a formula that will vary situation by situation, but we're going to use that formula to calculate the maturity risk premium. So the 1 year premium is going to be 0 because remember this only applies to long-term securities. The 10-year premium then is going to be 10 minus 1 or 9 times 0.1%. So that'll be 0.9%. And then for the 20-year premium, 20 minus 1 times 0.1% or 1.9%. So now we can put it all together because we've got an R star of 3%, and so now we can get our yields. So our 1 year yield is going to be 3% plus the inflation premium of 5% and the maturity risk premium of 0% will give us 8%. We can do the same thing for the 10-year and the 20-year. So now that last theory that we mentioned, the market segmentation theory, that just says that some borrowers and lenders like short-term maturities, some borrowers and lenders like long-term maturities. So the slope of the yield curve is going to depend on supply and demand relative to those who like short-term and those who like long-term. So some other factors that would influence the yield curve: Federal Reserve policy. What are they doing? Are they buying back? Are they buying or are they selling? Federal deficits, which we typically tend to have these days. International business, meaning what's the trade balance with our various trading partners, and how much business activity is there. So we're probably going to look at the gross domestic product primarily there. Now, finally, what happens to stock prices when there's changes in interest rates? Well, the higher the rate of interest, that means the lower a firm's profits, because it's going to cost them more to borrow and invest in their business. So interest rates affect the level of economic activity, and economic activity is going to then affect profits and then stock price. So the cost of money as a determinant of value, you can kind of see from this formula that the cost of money is going to be R, and so you can see how that's going to impact the value of an asset, because the higher R is, the lower our present value.